we'll take you through a retirement planner case study, and we'll use the example that you see on the screen for Greg and Jen, middle-aged couple earning approximately $200,000 combined. One will have a pension income, another one that has no pension plan but is an owner of a small business. Both qualify for CPP-OAS, and they'll want to do some extra traveling in their first 10 years of retirement and then scale back. Jen will sell her share of the business, and they'll also want to give some money to their adult children, and they have investable assets of about $600,000. So we'll go through a case study with them retiring at age 60, and then we'll do a couple scenarios to show how we can present them with a couple different retirement planner projection scenarios. So as a best practice, the first thing we should always do when we open up and log into FreshPlan is to make sure that we're working on the client file that we're creating the plan for. So we've already opened up Greg and Jen's file, but as a best practice, you should always go into the client's window first, and their file is at the bottom here. You can see that we've entered their first and last name and the year of birth. As a best practice, it's always a good idea to enter the name of the partner or spouse who will retire first and is usually older as the client, and enter the younger person or the one to retire second as the partner. So we've entered all this information before we started the webinar, and now we'll open up Greg and Jen's file. So the name in the top left-hand corner is the name of the file we're working on. So we'll work on just the retirement planner for this couple, and we'll work on it from within the calculate menu. Once we create a couple of scenarios, we'll go into the plan feature and we'll show you how to combine those different scenarios into a single PDF. So I've tagged the retirement planner as a favorite. It's the third item there. And the retirement planner is now open for Greg and Jen. So we've completed this plan before the webinar, and I'll just walk you through the main parts of it. So the income needs section, you can see that the month and year of birth is what we've entered in the client section. Their current incomes are about 100,000 for Greg and 115 for Jen. We're indexing those at 2%, and we're also retiring at age 60, as you can see up here. Because they want to travel a little more in the first 10 years, we set the income need at retirement at 85% of pre-retirement income. We've also, to reflect the decline in travel, we've changed their income need at age 70. So we've reduced that to 70% of what they normally would take at age 70. So that reflects their income needs and their travel retirement requirements. Now let's open up their investments. And Greg has $50,000 in non-register, and Jen has $200,000 to reflect some value in her company. And she's also receiving corporate income, and we'll show that as an investment instead of a withdrawal. So she's receiving $25,000 a year from age 55 to 60 when she retires. She'll sell the business, hopefully at age 60 for $600,000. So we're entering the same start age and end age to reflect that as a single event. And then in that same year, we're estimating taxes to be $150,000, so that will show up as a withdrawal also at age 60. And then in a few years' time, Jen and Greg want to give some money to their adult children, so we will show that as a withdrawal, and it's $75,000 per year for 2 years, so from age 65 to 66. So you can model any kind of cash flow in these two sections of non-registered. You can show it as a single amount, you can show it as a periodic amount, it's for 3 years or 5 years, and you can show money coming in as an investment or money going out as a withdrawal. So it provides you a lot of flexibility. In terms of their other investments, both have 50,000 in their TFSAs, and we're saying they're contributing 6,500 for the next 5 years until they retire. Their RSPs, they both have 125,000, and they're also contributing 10,000 a year for the next 5 years. And this is where you can also set the RIF parameters. We're just setting the RIF parameters to the minimum payment starting at age 71 for both Greg and Jen. Neither one has a money purchase plan or a LIF, so we'll leave this section blank. Rates of return, you can enter separate rates of return for each spouse, for each investment type. The default is 6% before retirement. We'll leave it at 6%, and then you can adjust the rates of return for the same investment groups after retirement, and we'll leave those at the default rate of 4%. Next, we can go into their pensions, their CPP, OAS, and any defined benefit plans. So both Greg and Jen will qualify for 90% of their CPP, and they'll start taking it at age 65. And they both qualify for the full amount of OAS, and we're not delaying the OAS. In terms of pensions, Greg will receive a defined benefit pension of $40,000 starting at age 66. He'll also receive a bridge benefit, so you can enter that as a separate line, $20,000, basically to reflect the amount of CPP and OAS from age 60 to 65, and then his work pension of $40,000 indexed to for the next 25 years. Jen has no pension income, but she does have other income. So this other income section, you can enter any other income that the spouses might have during retirement. It could be from a rental property, it could be from part-time employment, it could be from consulting. In this case, Jen will be doing some consulting for the business that she sold. The new owners will want her to keep her on and use her expertise. So for 10 years, she anticipates she'll earn $50,000 a year from age 60 to 70. So now we can have a quick look at the results, and we can see that they're just coming up a bit short. They'll have just over $1 million in assets at retirement, but they need about 1.1. And we can see how the assets grow between now and retirement, and then how the assets are drawn down. If you want to drill down, you'll notice in the distribution table, these numbers reflect a summary of everything that's going on. So if you want to drill down and see some of the cash flows that we entered in the non-registered investment section for Jen, we can refer to the supporting tables. And there's a trove of information here in all of the investment categories. So let's scroll down and we'll open up non-registered investments, Jen. And we can see the $25,000 per year that she was receiving from her corporation from age 55 to 60. This 475 reflects the net amount of the sale of her business. And then you can see that 70, and those are all inflows, so they're positive numbers. And then at age 65 and 66, we're gifting $75,000 per year to the adult children. So that provides you a great drill down for what's being displayed in the distribution table. If you want to include that supporting table in a PDF, we'll show you how to do that. You can click PDF, and you can see that we want to include supporting table. So click yes, and then you need to scroll down, and you can see we've selected non-registered investments for both partners. Keep scrolling down. We make sure that we check this box and then click save. And we've generated the PDF. And I'll just scroll down quickly to the bottom, and you can see that the non-registered tables have now been added to our report. So if you feel the client needs to have some additional information to see the exact cash flows. This is how you can add a supporting table to a PDF. As you can tell from the results, they're a little bit short. So one of the strategies we can investigate is to see what would happen if they retire at 65. So we can tell from the distribution table that they're not bringing in a lot of income between 60 and 65 because CPP and OAS aren't starting until then. There's some additional income here, but their income needs are still pretty high because they want to do a lot of traveling. So we're pulling a lot of money out of the non-registered and TFSAs, and you can see those numbers reflected here: 72,000, 131, 135, 139, 144, 123. So if we change the retirement age to 65, that money won't be coming out of the investment pool because they'll still be working. So the result should be an improvement. So to create a scenario while keeping the one that we have, we simply click on the scenario button. And we have the retire at 60 scenario that we're working on. So I've already created these separate scenarios, but I'll show you how to do that. So it's always the best practice to take the scenario that you've created and make a copy of it. So I'll click copy next to retire at age 60. A copy of that scenario is added at the bottom, and now we can edit it. We can edit the name. So we'll say we're going to retire at age 65. And I'll just to give it a different name to separate it from the one that we created, and click save to save that name. You can click the notes field to describe the scenario in more detail if you like. So both clients retiring at 65. Now we want to open this scenario. So the name of the scenario has changed and the notes have changed, but keep in mind, until you change the numbers to reflect the new scenario, the current results that we're looking at will be exactly the same as the one that we copied, because we've created a duplicate. So we need to change it. So all we're going to do is change the retirement age from 60 to 65 for both partners. I'm going to click save, and we'll look at the results. So we can see that the results have changed considerably by delaying retirement for 5 years. So they have considerably more money at retirement and considerably more money at the end of retirement. So this could provide them with a lot more flexibility. You could then go in, and if you were considering, in this scenario, gifting more money, if you wanted to double the money being gifted to the children, you can see that the ending value will go down considerably to reflect that. So this gives you a lot more flexibility then in terms of managing, creating other cash flows if they choose to retire at 65. So now let's create another scenario. They might look at this and say, well, we don't want to wait until 65. Is there something else we can do while we retire, while retiring at 60 because we want to travel? And we can create another scenario. So we'll click on the scenario button, and we'll make a copy of the retire at 60. So there's the copy. So retire at 60. Lower income. So now we've made a copy of our original scenario where we're calculating 85% of pre-retirement income. What we want to do now is just adjust this down to 75%. So we'll lower our income need a little bit. Maybe we'll travel 1.5 times a year instead of twice a year. Click Save. The scenario has been saved. We'll click OK. So now we have a scenario right in the middle. We'll have about the same amount of funds at age 60 as before, but now we'll have about $1 million left over. So just by tweaking our income need, we can adjust the plan and provide the client with another scenario. We want to create a single PDF that we can share with the client. So to do that, let's click on Plan. And we've already created a plan that includes that, but we'll show you how to do that. So let's click New Plan. And we'll call this Retirement Scenarios. And we're creating a plan from scratch. And we'll just click on Retirement Planner. And we'll just select the 3 scenarios that we just created. Retire at 60, retire at 65, and retire at 60 lower income need. Click Save. Now I'll add one more item. We created this before as well. We use the custom calculator, which is just a blank slate. You can type anything into it to summarize the results of our 3 scenarios. So we've created our scenarios plan, and now we'll open it. And the 3 scenarios are all included on the left-hand side. Just step through the cover page. And here's a summary of the 3 scenarios we created. Our first scenario, they're both retiring at age 60, taking 85% of pre-retirement income. In this scenario, the funds will be depleted at age 88, so they need about 100,000 more. So then we went to the next scenario where they retired at age 65. It changed the numbers considerably. And then our third scenario where we lower the income need to 75%, and we have the result that we saw in the scenarios. And then we have the 3 retirement planner scenarios in our plan. So this is the retire at 60, retire at 65, and then retire at 60 with a lower income need. And we're happy with our output on our results. We can simply click PDF plan. And a nice PDF is generated showing our summary, the retire at 60 scenario, retire at 65, and retire at 60 with a lower income need. So then we can save this to our hard drive and share it with the client, or print it off and share it with the client in a meeting. And that concludes our webinar on how to work with the retirement planner to create scenarios and generate a single PDF. Thank you.